Chetan Ahya is Chief Asia Economist at Morgan Stanley. He's joining us right now from the sidelines of the Morgan Stanley India conference, which is being held in Mumbai here. Chetan, thanks for joining in. Can you start with your view on the RBI policy, rates unchanged, SLR cut, and specifically your thoughts on what the SLR cut will achieve? Will it infuse more liquidity into the system, as is being projected, or it actually could raise the cost of borrowing for corporates as the government comes to the market to borrow? What's your sense?
Well, I think it is, honestly, I don't read too much out of this as a indication of the overall monetary policy stance. I think it's just one of those changes which they are implementing on a systematic basis, where they're trying to reduce SLR and they've just got back onto doing it now. As such, as you know, banks have put far more than a SLR requirement in the investments or the government securities. So they are already holding excess SLR beyond the statutory requirement. All what I would see in terms of functional day-to-day activity is that some of the banks can now go and use the collateral. The technical issue is that you can go to RBI to collect money under repo by depositing securities as collateral. Now, the amount of collateral security that would be available, because SLR has gone down, will increase. So that's the only technical advantage that banks have in terms of being able to access RBI window under repo with a larger amount of collateral. But that's it. I don't think really I want to make too much out of this SLR cut to start analyzing it into something.
Fair enough. So then almost 60-65% of a PSU bank's balance sheet is regulated, right? Priority sector lending, SLR, other things. Do you think this SLR cut is in a way the first step to sort of freeing that up? This is something that Dr. Rajan has pointed and hinted at in the past as well.
No, I think that is true. That's what I mentioned, that there is a systematic effort to reduce SLR and bring about changes in the way the banking system is operating. And so this is going in that direction. So that I agree with. But I think beyond that, there is not too much to read, because as such, it is not even going to be an effective change. So for example, today if banks were holding securities of government paper just right at the SLR level, and then if SLR is reduced, then there would have been some market impact or some change in the system. But to the extent to which banks are willingly holding more treasuries than the statutory requirement already, then the reduction of the statutory limit is not an immediate, there's no immediate impact of that on the banking system.
The big debate though, Chetan, I think still persists, right? Whether rates should be held higher for longer, and that will do at the end of the day the desired job of bringing inflation down, or it's not sort of doing any good, but it's actually hurting industrial activity growth, etc. There are enough people on both sides of the debate. Where do you find yourself, Chetan, on this one?
Well, I think the rates have to be held higher for some more time, until the time inflation is seen to be systematically heading towards RBI's comfort zone. At this point of time, the trailing data point is 8.6. The RBI's trajectory is that it will be around 7.5–8% in the first quarter of 2015. Even when it is 7.5 to 8%, it is still not the level which will give comfort to RBI to cut interest rates. So we think interest rates need to remain stable. As RBI has mentioned, if you get a positive surprise with inflation moving lower below that trajectory that RBI has forecast, then there is a room for rate cut debate. But at this point of time, we in our base case are assuming inflation trajectory to be very similar to where RBI is, which is that we expect it to be 7.5% by March 15. And so we think that rate cut will more likely be taken up around that time of March, April 2015, when RBI would be then able to take a call that, okay, it seems very likely that from now on we will be able to see inflation going even below 7.5%. And that's where the room for rate cuts will open up.
Got that. So this comparison, which is often made by the media and of course some people in the financial market as well, that the Modi-Rajan combo is like what we saw, we had in the US, right? Reagan and Volcker. When Paul Volcker raised interest rates, crushed money supply, brought inflation under control, and that laid the road for a strong growth and a bull market essentially for many years. So that is incorrect. That comparison is incorrect, you'd say, Chetan, right?
Not at all. I think the key thing is that a lot of the work to control inflation has been taken up. One is that the fiscal deficit has been brought down. Second is that the rates had already been taken up, and now we are, if you assume that, this 8.6% is going to begin to go towards, first 6.5% by December 14, but that's got some base effect in it, and then 7.5%. We are talking about positive real rates already. So if we had been having very high level of negative real interest rates, then there was a need to have a shock therapy and lifting interest rates dramatically. I think we have achieved some progress. Inflation has moved out from that 9-10% range to 8-8.5% range already. And there is a trajectory which seems believable going forward that RBI has laid out. I doubt there is a need to have a massive increase in interest rates at this point of time. I think synonymous argument for India would be to keep rates higher for longer. That's probably what I would argue for, rather than thinking about any rate hikes at this level.
Right. So you're basically saying you don't need a shock. You need rates higher where they are right now, stable for longer, but you don't need a shock. Do you think the government, the center, and we've had a regime change now, strong government, stable government at the center, will be okay with the RBI keeping interest rates much higher for much longer?
Well, actually speaking, I don't know why we have this debate in India all the time. If I may take liberty and dwell a bit more on this, is that every time we hear the government or the Ministry of Finance officials arguing for a rate cuts because to push growth. But in the process, if you are going to leave inflation higher and real rates negative, that goes against the same government's interest as far as their promise to the society at large and people at large is concerned to give lower inflation. So we have seen the outcome in this general elections, and we all know now that high inflation has been one of the factors which has affected the previous government in the political outcome. So why would a new government, which has actually gained out of the inflation not being brought down lower by the previous government, come into the job and first day start to take measures which will actually risk inflation staying higher for longer? So I think it's in the interest of the government to deliver what people have voted them for, which is to bring down inflation, and government's responsibility is equally there to ensure that RBI does what it needs to do.
Chetan, that's fine, but there could be an actual ideological difference as well. So I agree, the government also wants to crush inflation, the RBI wants the same thing, but people in the government, the new government especially, could have a different view about how to go about crushing inflation. Is the method of keeping rates high for longer the way, or should we try something else? Because this clearly hasn't worked, as some would argue, for the past many years. Whereas the RBI could have a different view. Is that possible, Chetan, or are you saying both are completely in tandem?
But no, what I'm arguing is that in the last 5 years, we've tried to hope for something else to come up and bring down inflation. But that's not happened. So now the onus is on the people who would have otherwise argued not to have interest rates high to prove the point that it's not interest rates which is the solution. Secondly, I think the other conceptual, I would say, judgment error which people make is that higher interest rates do not control food inflation, so why keep interest rates high? Now, what people need to appreciate is, why do you want to have interest rates low? Because you want to push growth. How would lower interest rate help? That would help people to borrow more and invest. But if you don't have interest rates which are positive on a real basis, then that would not attract enough saving from the households into the banking system. So how will you give credit? So it is not a starting point that is comfortable to kickstart growth. You need to have positive real interest rates. You need to encourage people to bring financial saving into the financial system, and then we can use that to push investment and growth. But without that in the system, if we cut rates and leave real rates negative, then it will be counterproductive and will not achieve the objective of taking growth higher.
Chetan, do you think the financial market understands this narrative very clearly as well? Or do you think there is still some confusion about what exactly is going to be the path followed by the government and of course the RBI. RBI, we know the path, but the government, what its fiscal policy is going to be, whether it's going to be in tandem with what the RBI's aims are. What's your sense?
I think financial markets understand that. I don't think there is an expectation of a very quick turnaround, either growth or inflation. In fact, if at all, I would say that there is more skepticism on the ability of the government to bring down inflation to that 6% forecast that even we have by March 16. Inflation will, we think, go down to 6%. So I would say there is more skepticism on the government being able to achieve that. So the market is not gone to another extreme to believe that this is all going to be possible. So there's a fair bit of skepticism on that.
Chetan, just talk about the conference which is on, the Morgan Stanley India conference which is on as well. Lots of speakers, lots of participants, attendees as always. What's the buzz? What do people really want to know?
The mood is, I think, is trying to understand what can the new government really do to achieve the promise that's what market is beginning to discount. So I think we've moved on to clearly that excitement of a stable government, strong government, into now looking at the nitty-gritties of each and every policies that can be taken up, and which one is taken up first, which ones are feasible, which ones are going to be taking time to implement. For example, GST will take time. Can a few other issues like approvals be taken up first? So I think the focus is on the nitty-gritty and the execution of the promise of reviving growth.
The May 12th report that you put out, actually it was a collaborative effort. The Next India, from a cyclical downturn to a structural upturn, that was what the report was called. And I just want to emphasize, it was written on the 12th of May. The election results came out on the 16th. So am I correct in sort of saying that you were calling for a structural upturn in terms of growth, markets, etc., irrespective of what the government would look like and what the government would be able to do, Chetan? Is that a correct assumption?
That's right. But I would say that the report was written on 12th May before elections, but it did have a critical assumption that we will have a stable government. Now what we've got is a strong and stable government, which is that we've got majority for the single largest party. That's not something that we had in our expectations. So to that extent, there is definitely a positive surprise to the forecast that we had made on May 12th, and therefore we have made changes to our growth forecast as well. So for example, what we had before elections was the exit quarter of March 16 financial year. So call it March 16 quarter. We had GDP growth at 6.2% on a year-on-year basis. That's now been lifted to 6.8%. So we have lifted our growth estimates in line to reflect a strong government that has come through on May 16th.
Chetan, so what are you calling for in this sort of big report, the first of a series of reports? What is the basic premise and what's the conclusion of this report?
The basic premise is that India has got the essential components which delivers strong, sustainable growth, right? And those are essentially, first is a supply of labor and talent, which is demographics. Second, we think that there is a benign benefit of globalization that's been occurring to India, which will continue to come through, which is that India will be able to gain on account of higher trade with the global partners, as well as it will gain from the capital inflows, which enables it to adopt technology and improve productivity. And the third is reforms. You can have positive demographic trend, but if you don't create the platform for working age population to work, which is that if you don't take effort to reform and mobilize non-labor resources adequately, then you'll not be able to realize that strong benefit of demographics. So, taking all these three factors together, which is demographics, globalization, and reforms, which creates the platform for workforce, we are thinking that we are expecting GDP growth in India to be averaging at 6.75% over the next 10 years. And we think it will take India's GDP from $1.9 trillion today to $5 trillion by 2025. And at the end of that period, in 2025, India will then become the 5th largest economy in the world from currently the 10th largest.
Chetan, let's keep demographics, which have been around for a long time, as you said, aside. Let's keep the global opportunity, export opportunity aside for just a bit and talk about reforms, right? Because that's what you said. Attendees at the Morgan Stanley conference are focused on as well. So what specifically, Chetan, would you like to see from the new government in terms of reforms, the last thing?
I think budget is probably overemphasized in terms of its significance and importance to turn the direction of the economy. I would say it's the cumulative set of measures from tomorrow rather than just budget, because budget will anyways be a single day announcement, but what really matters is the execution on a day-to-day basis that the government takes up. And we would club the reforms in two buckets. First is sort of being able to do what we were doing between 2004 to 7 in form of private investment. And related to that, there will be a major shift in the way the government approaches interaction with the private sector for trying to get their investments going. I think the big shift which has happened post 2010, I would say, since the time that we've had back-to-back corruption related investigations, is that the government's ability to interact with the private sector is now going to be defined by a new set of transparent mechanisms. In the past, it was possible to do it in a different manner, but now with the way the focus of media and the well-connected middle class is on the government to deliver governance, the new systems will have to be installed. So I think the biggest focus for us is that whether the government is able to install transparent mechanisms to allocate critical national resources to the private sector, and then allow them to take the private investment to GDP higher, which means environmental approvals for coal mining or iron ore mining, getting land for putting up investment projects. So all those allocation of critical natural resources will have to be done in a transparent mechanism. That's a big challenge. So that's the first one. And the second is more what we had not been able to do even in 2004 to 7, which is that we need to somehow think about creating pockets of competitive areas which can begin to take market share in global goods exports and then try to attract more investment for outsourcing for manufacturing rather than just doing outsourcing for services. And so that, I think, involves two critical components. One is to lay out competitive infrastructure in pockets to start with, and then also try and implement labor reforms again in pockets, which I would suggest probably to start with special economic zones. And that's how you can sort of take it to the next level, even above where we were in 2004 to 7.
Chetan, so what you're referring to essentially is the government process itself, right? How the government functions, the interface it has with the business, with big business especially, and how that kind of broke down over the last 5 years or so under the previous government. With the new government, and sort of you've been meeting officials, part of the new government, who are close to policy makers in the new government as well. What's been talked about is a kind of a hub and spoke model where the Prime Minister's office will drive policy and individual ministries will implement those policies. Is that the correct way to look at things in your assessment?
Well, not really. I think that's in the way in which the Prime Minister is exercising his powers or the powers of executive. But what I was referring to was to really set up institutional mechanisms in which when the government interacts with the private sector. See, if you remember what was happening in the 80s was the public sector was doing all the infrastructure spending. Then came the balance of payment crisis, and because we had committed to IMF that we will reduce fiscal deficit, the government actually reduced fiscal deficit by cutting expenditure on infrastructure and capital expenditure, and they completely withdrew from that area. When we tried to grow fast in the 90s, at that point of time with a lot of business capex, not having enough infrastructure, we faced inflation in the mid-90s. So we learned that we have to do infrastructure spending, but then the government could not do it. So the government said we'll get private sector, which really took off in 2004-5. And when it took off, it was operating under institutional systems which were not really foolproof to deal with the private sector in a transparent manner. And that's what I was arguing, that we need to fix it now. Well, it's getting fixed. I mean, we know that 3G was done in a transparent mechanism through auctioning. And that's where we actually had problems with what had happened with 2G. But that's the kind of thing that we are going to have to constantly evolve and ensure that the investments are taken up by the private sector with some discretionary power available by the government to give them land resources in a transparent manner so that it's sustainable. If it is not seen to be done in a transparent manner, we have today 220 million internet users, and that's the middle class, which is going to ask for that governance and transparency.
So, right. So, let's take, for example, the land bill. Actually, the land bill is not a bill anymore. It's law, right? It's been passed through the parliament. So, what do you expect there, Chetan? Because it's a crucial thing. Industry is not happy with it. I think a majority of financial market participants aren't happy. People like you. Do you expect the new government, to work within it, or do you expect it to actually change it?
Well, I've heard some of the BJP officials speak in the media, but what I kind of see there are two issues. One is the compensation debate as to what is the price that we need to pay to the people when you acquire land from them. And second is the processes involved in terms of doing transparent social hearing before you acquire the land, etc. And I think what the new government will probably try to do is to not probably change the price at which they buy land from farmers, but the process of acquiring land, that needs to be a bit more manageable. Today, speaking to the companies, we feel that the process is so cumbersome that it's almost land acquisition has come to a standstill. So we are optimistic that the government will work towards that to ensure that the process is smoothened enough so that things can function.
Right. The other point is domestic manufacturing, right? And I think you'd agree it's important. Every time we've had a big boom here, it's been inevitably followed by, BOP crisis type of situation because imports surge and we don't have enough exports. So to fix that and to have a sustainable boom, you need a strong manufacturing base. And there, labor reforms are necessary. We haven't heard very much from the new government or the party's manifesto on that front. Labor reforms, it's a sensitive subject. What's your expectation? Do you expect that to be addressed on priority, or it will take a number of years?
I think it will take a lot of time, and I do think that it is not the first in priority that we have. Today, I think the biggest issue is what I mentioned to you, that there are a lot of powers within the executive which doesn't need legislative changes and can be done. And if those are done in priority, that itself will lead to our growth rates accelerating to 6-7%. And if we get to 6-7% with inflation going down to 6%, we will be effectively the highest productive growth country in the world. We have China achieving 7.5% GDP growth rate, but we know that there are other macro stability issues attended along with that in form of overcapacity, NPLs in the banking system, and excess capacity is reflecting in pricing power being negative YOY for the producers with PPI inflation at -2%. So I think, for us, the focus needs to be getting that executive power working, and we ensure that we get that growth rates going up to 6-7%.
Chetan, before we wrap here, one last point, and this is about the fiscal deficit. Now, you'd agree that the way in which governments and economies which have faced slumps in the past, economic slumps in the past, have resorted to government spending as a way to sort of lift the economy out of the slump. It's been done before successfully. Now you have a situation where the financial markets don't want governments, not just the government here, but governments around the world to spend. There is this fiscal deficit, red line, sovereign ratings, and all of those things. In the long term, I agree that the Indian economy is sort of supply starved in a lot of areas. But right now, how do you kickstart and bring back demand to lift sort of the economy out of the slump that we are seeing without government spending? Because the private sector will not spend unless it sees the government spending as well. What's your sense?
Well, I think they have to walk a tightrope. So you can't have a major contraction in fiscal deficit right now. That would be difficult and also will be a bit more counterproductive. So we are looking for government expenditure growth to be more in line with nominal GDP. India's expenditure to GDP has in fact come in line with the cyclical lows that we have seen in the past. The problem today with the fiscal deficit being high is because the tax to GDP has come off quite significantly. And so in some ways the solution to fiscal deficit lies by initiating those reforms which